Good afternoon, everyone, and welcome to another one of Avant-Garde Trading's free educational trading webinars. Thank you for joining us this afternoon. We are thrilled to welcome Ken Keating, Principal at the OCC and Instructor at the Options Industry Council. He is here this afternoon to speak to you all on demystifying the Greeks, and he's got a lot to go over this afternoon, so we're thrilled to have him. Ken, are you with us?
I am, Natalie. Can you hear me fine?
Yes, hi Ken, I can hear you nice and clear. Thank you again for putting this presentation together and taking the time out of your schedule to come chat with everyone here.
Absolutely.
We have a lot of people ready and raring to go. So whenever you are ready, you can go ahead and share your screen. As a reminder to everyone listening and watching, while Ken is pulling up his presentation, if you have questions while you're going through the presentation, please type them in the chat box or the Q&A box, and I'll get those questions over to Ken at the end of the presentation so that you can address those live. Ken, I can see your screen. Looks great. Whenever you are ready, feel free to begin.
Great. Well, thank you, Natalie, and welcome everyone to another Avant-Garde OIC-sponsored webinar presentation. As Natalie mentioned, my name is Ken Keating, and I'm Principal at OCC Investor Education, as well as an Options Industry Council instructor. And I'll be giving today's presentation on demystifying the Greeks. So before I get started, I just want to send a big shout out to Natalie and all the great people at Avant-Garde Trading for all they do for the ever-growing community of options investors with their amazing trading platform and competitively low rates. So currently, I've been working at OCC for roughly about 5 years now, 5+ years. But before coming to OCC, I was a professional options trader for well over 25 years. So I traded as a market maker, both on the Pacific Coast Stock Exchange, as well as the floor of the Chicago Board of Options Exchange in the mid-90s. I've worked as a floor specialist, floor market maker. I ran off-floor prop books for capital management firms. I've run risk management desks. I've traded for myself for many, many years as a sole proprietor, and I've also worked as a derivatives and equities analyst. So currently I work at OCC, helping individuals such as yourselves to better understand both the risks and the benefits of exchange-listed options. So speaking of the risks and benefits, we always have to mention our disclaimer. Options are rather complex vehicles and need to be properly understood before trading in a live account. So anyone considering trading options should thoroughly read and understand the characteristics and risks of standardized options, which you can obtain by visiting us at optionseducation.org to download a free digital copy. Or if you prefer a physical copy, you can always reach out to your broker or any exchange on which options are traded. In order to simplify the calculations used today, commissions, fees, margin interest, and taxes have not been included. And lastly, any strategies we discuss here today are strictly for illustrative and educational purposes. All right, here are some of the trademarks and logos that you will see throughout the presentation. This is strictly for all the lawyers at OCC. A little bit about OIC, who I work for, the Options Industry Council. The Options Industry Council is effectively the education arm of our parent company, OCC. So OCC is the Options Clearing Corporation and is the world's largest equity derivatives clearinghouse for exchange-listed options, as well as the Foundation for Secure Markets in the United States. So OIC started out as a cooperative in 1992 to educate the public both on the risks and the benefits of exchange-listed options, and we do that primarily through our website, optionseducation.org. There you'll find free online courses, podcasts, videos, as well as additional webinars, just like the one you're listening to today. And this is a free service. And the reason why we can offer you this service completely free of charge is because we are fully funded by our parent company, OCC. So we're not looking to charge you a subscription or tiers of service or charge you by the product. We only want you to be fully educated, understanding the product, and hopefully using the product responsibly and successfully. So if you ever have questions regarding options, you can always reach out to us at options@theocc.com Monday through Friday from 8 a.m. to 4 p.m. Central Standard Time with any and all of your options related questions. So I work on a desk with 3 other very talented individuals, and collectively we have roughly about well over 100 years of brokerage and trading experience. So if you ever have a question about the product, don't hesitate sending us an email. One thing I do have to mention, though, is as we are not registered advisors, we can't direct you on trades. We can't suggest trades. We cannot critique your trades, but we can talk to you about general options theory, general strategy, optionality, also how corporate action may impact your options position. If you trade long enough, at some point you will be presented with some type of a corporate action, say a merger or a split, a forward split, a reverse split, maybe a rights offering. And these all affect options contracts differently. So if you ever have a question along those lines, certainly shoot us an email. We're always more than happy to help out. Okay, here's one of my favorite charts here. This is annual options volume over the last 20 plus years. And as you can see, the growth of the product has just really been phenomenal. So I left the trading floor, the Chicago Board of Options Exchange, right at the end of 1999, right around 2000. And back then, that was right around where the internet bubble was just kind of cresting. And obviously, the internet bubble popped in 2001. But here in 2000, we were averaging about 2 million contracts on a daily basis, which at the time felt like a lot of volume, and it certainly was. But you contrast that today, where we are averaging 47.8 million contracts on a daily basis. So last year alone, 2023, was a record year for OCC, where we cleared and settled 11.2 billion contracts. And currently, today's volume, average daily volume, is 8% higher than last year's record volume. So if volumes stay where they are, we are on track to basically clear and settle roughly north of 12 billion contracts. So certainly no lack of investors using the product both to hedge and speculate and achieve their investment objectives amidst all the volatility that we've been witnessing over the last two decades. Okay, so here is our presentation outline. So today I'm going to be going over the option Greeks. So first I'm going to do an overview of the Greeks, and then we will get into the 5 first order Greeks. First, I'll talk about delta. Then I will talk about gamma. We will then move on to theta. Then I will talk about Vega. And lastly, we will talk about rho. Now, Q&A please, you can submit your questions during the presentation, and time permitting, I will bring back Natalie and maybe we will handle some Q&A live. All right, with that out of the way, let's get started. So the Greeks, these are the 5 first order Greeks. There's delta, gamma, theta, vega, and rho. And one way I like to think about the Greeks is the Greeks are kind of like a dashboard to your options position. So just like you have a dashboard on your car, that dashboard on your car is giving you feedback as the condition of your car. If you look down at your dashboard, you see you have a quarter tank of gas, maybe your tire pressure's a little low, maybe your engine's running warm. Now, your dashboard is giving you feedback as to the condition of your car. Well, your Greeks are essentially giving you feedback as the condition of your options position. In other words, where your risk lies, how your position can be affected by, say, changes in the stock price, changes in time, changes in implied volatility, changes in interest rates. Okay, so each one of these is going to be examined in the presentation, but just know that this is how what traders use to essentially measure risk. Okay, so this allows traders to anticipate how their positions might be impacted by changes in stock price, time to expiration, implied volatility, et cetera, et cetera. So you can kind of think of the Greeks as the language that traders use to speak to each other about risk. So if you were ever in a trading pit, you might hear traders talk to one another and say, what's your delta? Or how much gamma are you long? How much gamma are you short? What's your vega? Okay, this is always traders. This is a language that traders have that allows them to talk about the risk that they have on their positions at any given time. Okay, so the nature of the Greeks. the Greeks are only meaningful during an option's lifetime, meaning at expiration, they completely disappear, okay? Because at expiration, options are either in the money and have intrinsic value, or they finish out of the money with no value, okay? There's two outcomes, okay? So it's only meaningful during an option's lifetime. So also one thing to keep in mind is Greeks may affect other Greeks, okay? So a change in an option's theta, which we will get into, your time decay, may have an effect on your option's delta. A change in implied volatility may have an effect on your options delta as well as your options theta. So Greeks do affect other Greeks. And the impact of these Greeks may differ between whether we're looking at an in-the-money contract versus an out-of-the-money contract versus an at-the-money contract. So depending on what contract we're looking at, as well as what duration, whether it's near-term or far-term, is going to, these Greeks have an impact in a different way depending on which kind of contract and what duration that we are looking at for that contract. So, all right, so let's get started. Delta. Delta is the first order Greek. What exactly is delta? Well, delta is your options sensitivity to changes in stock price. In other words, how much my options value is expected to change with each $1 move in the underlying stock price, okay? So deep in the money options, okay, have very high deltas, anywhere from 0 to 1, okay? So if a stock's trading for 100 and we're looking at the 50 level call, well, that 50 level call is $50 in the money. It's very deep in the money. It's probably going to have a delta approaching 1, meaning that if the stock goes up by $1, that option should go up by $1. And if the stock goes down by $1, that option should lose about $1. At the money contracts have deltas right around 50, or they move about half as much as the stock. So if we're looking at the 100 level call with the stock trading 100 and have delta, well, if the stock moves up by $1, we would expect that that option would gain about 50 cents. Likewise, if the stock went down by $1 from 100 down to 99, we would expect that option to lose roughly about 50 cents. Far out of the money options have very low deltas, probably in the single digits or possibly close to 0. Okay, so in other words, those out of the money options need a lot of stock movement in order for them to take on a decent amount of value. Okay, so something to keep in mind also that that options, the deltas will differ obviously. Between whether we're looking at in the money, at the money, or out of the money. And once again, it's your option sensitivity to each $1 move in the underlying. So calls have positive or long deltas, okay? So they are positively correlated to the underlying stock price. So as stock prices move up, we would naturally see call prices moving up. If stock prices move down, naturally call prices would move down, and call deltas can range anywhere from 0 to 1. 1 meaning 100 delta, 0 meaning just no deltas whatsoever. Puts, on the other hand, have negative or short deltas, and they have a negative correlation to the underlying stock price. So if a stock rallies, put prices will naturally decrease by the amount of our delta. And as a stock price moves lower, well, that's going to benefit put prices, and put prices would naturally increase by the amount of our delta. And put deltas will range anywhere from 0 to -1. Okay, so another way people or traders look at delta is its probability of finishing in the money. Okay, so if we're looking at a 70 delta call, maybe stock's trading for 100 and we're looking at the 85 level call and it expires in a month, and maybe it has a roughly about a 70 delta. Traders could view that as indicating that this option has about a 70% chance of finishing money. Well, if it has a 70% chance of finishing in the money, naturally it would have a 30% chance of finishing out of the money. Because remember, at expiration, that option is either you're going to be in the money or it's going to finish out of the money without any value. Okay, those are the only two outcomes. So at expiration, those probabilities have to add up to 100. Now, if we sold a 30 delta call, okay, well, a 30 delta call has a 30% chance of finishing in the money. But if we're short the call, that could indicate that that option has a 70% chance of finishing out of the money and a 30% chance of finishing in the money. Now, this is also a very important concept. Whether an option finishes in the money is not to be confused with profitability. So just because we have a 70 delta option that indicates it has a 70% chance of finishing in the money, that doesn't mean that you have a 70% chance of being profitable. So what do I mean by that? So if a stock is trading for 100, and let's just say we bought the 95 level call for $6. So that option has $5 of intrinsic value and $1 of time premium. Well, let's just say the stock doesn't move at all, and fast forward expiration, stock's trading right at 100. Well, with no time remaining, that option has an intrinsic value of $5. It's $5 in the money, but remember, we paid $6 for it. That $1 of time premium has evaporated. So even though that option finished in the money, we still lost $1 on this contract. So just keep that in mind, that an option's probability of finishing in the money does not equal its profitability. Okay, so it's two different concepts. Okay, so let's do a quick knowledge check, and these are always fun. It kind of helps reinforce what we talk about. So we have shares that are trading right around 100 with 45 days to go to expiration. You have various call strikes with their corresponding deltas. So I'm going to throw some questions at you. You can just pull out a piece of, flood the Q&A box with answers, please, but just kind of follow along if you want. If an investor buys the 110 calls, okay, they're $10 out of the money, and let's say they pay $1 for them, what do you think is the expected options value if the shares increase to 105? So if the shares go from 100 to 105, what do you think the value of this 110 call is worth after we paid $1 for it? Well, this is where you have to use the options delta. So we see that this option has a delta of 0.20. In other words, this option should gain about 20 cents for every dollar move in the underlying. Well, in this case, the stock made a $5 move. So to figure out your the price on this stock, or I'm sorry, this option, you would have to take that $5 move and multiply it by your delta. 5 times 0.20, that's 1 or $1. We would add that $1 to the dollar that we paid for the option. So we would expect this option to be trading roughly $2 on a $5 move in the underlying, all other pricing factors remaining constant. So this is also a very important concept. So we're looking at delta in a vacuum, okay? So this doesn't count what implied volatility might be doing, time to expiration, whatnot. We're just looking at delta in a vacuum. If all of a sudden the stock goes from 100 to 105 quickly, we would, in theory, expect this option to gain roughly about $1, but it's not perfect. It's just an estimation based on the delta itself. Okay, if an investor sells 2 of the 90 strike puts, okay, these out of the money puts, stock's trading 100, we're going to sell the 90 level out of the money puts. What do you think is the estimated probability that the option contracts will finish out of the money? Well, remember, if it's got a 15 delta, it has a 15% probability of finishing in the money. But if we sold these puts, in other words, sold 2 cash secured puts, 15% chance of finishing in the money, well, then naturally, you would have to have an 85% chance of finishing out of the money, okay? And if we're short it, we want it to finish out of the money, okay? So if you picked 85%, you got that right. Okay, if an investor buys the 100-110 call spread, in other words, we're going to buy the 100, the at-the-money 100 calls, we're going to sell the 110s against it, we're going to put on a $10 bull call spread, and we're going to pay $3.20 for that spread. So what do you think the expected value of the spread is should the stock increased to 105. Well, here's where you have to do a little math. So once again, you're going to have to net out the deltas of this spread. So if we buy the 100 calls, they have a 50 delta. We're going to be long 50 deltas for every contract that we buy. And if we sell the 110s against it, now we're going to be short 20 deltas. Okay, so 50 minus 20, that's 30 deltas. So we would expect this spread, the 100-110 call spread, would have a net delta, net positive 30 deltas. Well, if the stock increases by $5, okay, now that we net delta, well, how much is our spread theoretically going to be worth? Well, you take that 0.30, the delta on the spread, multiply it by 5, that gets you to $1.50. Add the $1.50 to the $3.20 we originally paid. We would expect this option to be worth roughly about $4, or this spread to be worth roughly about $4 on a $5 move, all other pricing factors remaining constant. Okay, so that is delta. Now let's look at gamma. And this is actually a great subject to be talking about, given the huge moves that we've been watching in the market over the last couple of days. We had a big move Friday. We had a really big move Monday. You know, we bounced back today. So what exactly is gamma? Well, gamma is your delta's sensitivity to an underlying stock price change. In other words, how much my delta is expected to change with each $1 move in the underlying. Okay, it's always looked at in a decimal form. It's the adjustment to delta. So I like to think of my gamma as the speed of my delta. Okay, in other words, how many deltas I would pick up with each dollar move in the underlying. Okay, so when you think about gamma, gamma is kind of like the pent-up energy within an option itself. Okay, the potential for the option to move should the underlying move. And this is what option buyers are paying for. Not only are they buying time for their forecast to work out, but when they're buying options, you're essentially buying gamma. Okay, because when you own options, if you own calls, you want that stock to move in a big way to the upside. And if you own puts, you want that stock to move in a big way to the downside, okay? Because that's going to, long gamma benefits from movement, okay? Both up and down. So gamma is going to always be positive depending, it's what you do with the option that turns it into either long gamma or short gamma, and only options have gamma. So the gamma is going to be the same for calls and puts that share the same strike. So as the gamma for calls, as the stock price increases, your delta should increase by the amount of your gamma. And as the stock price decreases, your delta should decrease by the amount of your gamma. So in other words, if you're long calls and the stock goes up, you're going to be getting longer and longer deltas. Your delta is going to be increasing by the amount of the gamma, and which is good. You know, if you're long calls, that's a good thing. You're going to be getting longer and longer as the stock rallies. Just like if you were long puts and the stock goes down, you're going to be getting shorter and shorter deltas. Okay, so as the stock price goes down, or as the stock price goes up, the delta of puts actually decreases by the amount of your gamma. And likewise, if the stock price decreases in your long puts, the delta will increase by the amount of your gamma. So once again, gamma is what option buyers are paying for. So it's the acceleration of delta or the delta of delta. So, you know, like with all the volatility that we were witnessing over the last few days, you know, anytime you see a lot of open interest on one strike, okay, well, somebody's long that contract, and at the same time, somebody is short that contract, okay? So when stocks make big moves through strikes, such as on Monday, where, you know, the market was down in a big way, and the S&P 500 and different stocks blew through a lot of different strikes, okay? Well, that's good for people who are long gamma, because they're getting shorter and shorter on the downside. It's bad for people who are short gamma because they're getting longer and longer on the downside. So, once again, people who are long gamma want stocks to move, and people who are short gamma don't want stocks to move. Okay, so if you're long options, you're going to be long gamma. If you are short options, if you're an option seller, you're going to be short gamma. So gamma is not going to be the same for the same strikes at different durations. So let's look at the money strike. We have a stock trading right around 100, and we're going to look at the 100 calls and puts. Okay, and they are going to have, as you can see, we have options that expire in 10 days. This curve right here, options that expire in 30 days, 90 days. 180 days and 360 days, the longest. Okay, so all these options have gamma, but the options that have the most amount of gamma are the near term at the money options. Okay, because they are the most sensitive to movement in the underlying. Okay, because remember, at expiration, that option's either in the money or it's not in the money. It's going to finish worthless. Okay. So if we are looking at an option that expired, so let's just say today was expiration, well, that would have even more gamma than this 10-day option. The curve would be up here. Okay. So when you get closer and closer to expiration, this is why people say when you sometimes hear about exploding gamma, this is what happens to the at the money strike. The gamma, the at the money strike, explodes at expiration. Now, as expiration nears, the gamma of the at the money calls and puts naturally increase, and the gamma of both the in the money and the out of the money calls and puts naturally decreases. Okay, so once again, that when a stock's right at strike at expiration, those options are going to have a considerable amount of gamma. Okay, and depending on whether you're long the option or short the option, depending on how that stock moves, can impact you in a very meaningful way. All right, so let's do another knowledge check regarding gamma. So we have shares trading right around 50 with 10 days to go to expiration. So we have various call strikes here on the left. We have their respective deltas and the respective gammas. So if an investor were to buy the 50 level calls right here, the at the money calls, and the shares increase to up $2, so stock rallies from 50 to 52, what do you think our new expected delta would be? Well, if we bought this option, it has a 51 delta. So when we bought the option, we'd be long. For every contract that we bought, we'd be long 51 deltas. Okay, so if we bought one call, we'd be long 51 deltas. If we bought 10 calls, we'd be long 510 deltas. Okay, so remember that this is per contract. So if the stock rallies from 50 to 52, what do you think our new delta is going to be? Well, this is where we have to use our gamma. So we know that the gamma of this contract is 0.12. So now we multiply our gamma by this $2 move. $2 times 0.12, that gets us to 0.24. Add the 0.24 to our original delta of 51. That gets us to a new delta of 75. So all other pricing factors remaining constant, if the stock rallies $2, we would expect our new delta to be 75, okay? If an investor were short the 50 calls, maybe they sold these calls against a stock position, also known as a covered call, would a share price increase to 52 result in an increase or a decrease in the amount of gamma that we're holding? What do you think? Shares rally from 50 to 52, would that result in an increase or decrease in gamma? Well, if the shares rally from 50 to 52, our delta is certainly going to increase on the option, but our gamma, well, it's actually going to slightly decrease. Remember that the at the money contracts have the most amount of gamma. As you can see by this chart, with the stock trading 50, the at the money, the 50 level call in this case has 0.12 gamma. But as you move away from, you get deeper in the money or further out of the money, the gamma decreases. So if all of a sudden the stock goes from 50 to 52, now the 52 level calls will be the at-the-money calls. They'd have the most amount of gamma, probably about 0.12. And the 50 level calls, while they'd still have gamma, they would have less gamma. So your gamma decreases as you move away from the at-the-money strike. All right, so if a trader were long 10 of the 52 level calls and shares increase from 50 to 51, how many shares would they need to buy or sell in order to maintain a delta neutral position? So I'm going to kind of put you in the mind of a market maker, somebody I used to be. So when I was on a trading floor and I'm in my trading pit and a broker comes in, they sell a bunch of these 52 level calls. And let's just say I have no position on. Okay, so I buy 10 of these 52 level calls. Okay, well, each one of them has 29 deltas. So if I buy 10 contracts, that's the equivalent of being long 290 shares of stock. Okay, well, as a market maker, I don't really have an opinion on the stock. Obviously buying the calls, I'd love the stock to go higher, but I really don't. I'm kind of agnostic when it comes to direction. I'm just trading a bid-ask spread. So maybe I don't want these deltas. So what I would do is I would go out, I'd buy 10 of these calls for whatever price. They have 29 deltas. I'd be long 290 deltas. I'd go out and I'd sell 290 shares of stock. So now I'd be long 10 of the 52 level calls and short 290 shares of stock. That's what's known as being delta neutral. Now, I'm not suggesting that you as an individual investor trade delta neutral. You certainly can. This is more geared towards professional traders who are really trying to trade a bid-ask spread and maintain their risk exposure. But I'm just trying to help you understand like how a market maker might adjust their position. So if all of a sudden I'm long these calls, I sold 290 shares of stock, I have no delta, but I have a position, and stock rallies from 50 to 51. Well, how many shares would I need to either buy or sell to remain delta neutral? Well, once again, we have to look at our gamma. Our gamma is 0.10. Okay, so if the stock rallies $1, I'm going to gain 10 deltas for every contract that I'm long. Well, I'm long 10 contracts. Okay, so 10 times 10, that's 100. I would be long an extra 100 shares of stock. So I would have to go out and sell another 100 shares of stock. So I'd sell 100 shares of stock. Now my position would be long 10 of these 52 level calls and short 390 shares of stock. Might be completely delta neutral. So now I don't care whether the stock goes up or down. I just want it to go move in either direction. If the stock moves up, I'm going to get longer and longer. I'm going to continue to get longer and longer deltas. I'll have more stock to sell. And the stock goes lower, I'm going to get shorter and shorter deltas because now I'm going to be short stock against these. I'm going to lose deltas on the downside, and I'm going to have stock to buy. Okay, so if people are long options, this is how people who trade delta neutral make money. They're just trying to scalp stock intraday, and hopefully that the amount that they're scalping ends up being more profitable than the theta or time decay, which we'll get into in the next couple slides, takes away from you on a daily basis. All right, so this is a good segue. Theta or time decay. Theta is your option sensitivity to changes in time. In other words, how much your option is expected to lose with the passage of 1 day. It's always expressed in a decimal form, and it represents a calendar day, not a trading day. So remember that options do expire on weekends and holidays. Okay, options don't really sleep. So it represents a cash amount per option, all other factors remaining constant. So calls and puts have both negative theta. Okay, so theta is a foe to option buyers and a friend to option sellers, because every day that the stocks don't move, in theory, those options are worth less and less because they lose a certain amount of time decay as they get closer and closer to expiration. Okay, so once again, people who are long options need movement between now and their expiration. People who are short options don't want movement. They want that stocks to be very quiet and just trade in a very tight range, and hopefully that theta comes in and their options decay on a daily basis. Every day that those options decay, those options that they're short are worth less and less, and theoretically they can buy them back cheaper and cheaper, okay? So an example of theta and time decay. So let's just say we have an option. It's trading today at $3.50. It has a theta of 3 cents. So if we were to buy this option, it would cost us $350, because remember that every option has a 100 multiplier, because every option is the right to buy or sell 100 shares of stock. So if I buy this $3.50 contract, it's going to cost me $350. Well, if it has a theta of 3 cents, if the stock didn't move between today and tomorrow, in theory, I would expect to lose about 3 cents for every contract that I'm long. In other words, this option should be trading for roughly $3.40 tomorrow. If the stock doesn't move, implied volatility doesn't move, once again, all other pricing factors remaining constant, we're looking at theta in a vacuum. Now, what's the expected value 10 days from now? Well, roughly about 320, okay? 10 days of value and 3 cents of theta, 10 times 0.03, that's 30 cents. 10 days from now, this is, and remember, this is just an estimate, okay? It's not entirely perfect, but it just gives you an idea of how much you're expected to lose, in this case, over the next 10 days. So we would expect this option to be trading kind of around $3.20, assuming all other pricing factors remaining constant. Now, the one thing about theta is it's not, time decay is not linear, okay? So in other words, you would think that options, the further dated options that have more time premium in them, would decay more so than the near dated options, okay? But actually, in fact, it's just the opposite. The further dated options aren't subjected to time decay as much as the near dated options. So as you can see, we're looking at the at the money options here. And right when you get around 30 to 40 days out, you see the slope of this line gets steeper and steeper until at expiration, there's no time premium remaining, okay? So people who like to sell options, that's why they typically target the options that are anywhere from 30 to 40 days out, because of this more pronounced time decay, okay? So, you know, the further dated options aren't subject to time decay as much as the near dated contracts, okay? So once again, time decay isn't linear, it's more exponential, okay, as you get closer and closer to expiration. In the money contracts and out of the money contracts, while they also do decay, they decay in a more linear fashion, only because those options don't have as much time premium in them. The options that have the most amount of time premium are always going to be the at the money options, because their premiums are comprised of 100% time premium. All right, so now let's do another quick knowledge check. We have shares that are trading right around 100. And let's just say we buy the out of the money put spread. We bought the 95-90 level put spread for 50 cents. Okay, so maybe we bought the 95 puts for $1. We sold the 90 puts for 50 cents. It cost us 50 cents to put on this out of the money put spread. Do you think theta helps or hurts this position? What do you think? Well, because we are long one contract and short another, we are contract neutral. But since we're long the 95 level puts, they're more premium heavy, we actually paid a net debit for this position. So theta in this case actually is going to hurt this position. If the stock stays right around 100 come expiration, this put spread is not going to have any value. Okay, both options are probably going to expire out of the money and worthless. Okay, so theta actually hurts this position. Okay, here's a little tricky one. If we compare the 80 strike calls with stock trading 100, okay, they're trading for $20.25. What do you think has more theta? The 80 level calls trading for $20.25, or the 85 level puts trading for 40 cents? Which option do you think is more affected by time decay? Well, naturally, you might think that the 80 level calls, because they're more premium heavy, are subject to more time decay. But you have to look at the in-the-money options have two components. They have an intrinsic value and an extrinsic value. So with the stock trading 100, the 80 level calls are $20 in the money. And if they're $20 in the money, well, this 25 cents of remaining value is consisted of time premium. Okay, they have $20 of intrinsic value and 25 cents of time premium. Where the 85 level puts are comprised of, they're out of the money, they're comprised of nothing but time premium. So in this case, the 85 level puts would decay at a greater rate than the in the money 80 level calls. Okay, because remember, it's the extrinsic value or time value portion of the option that is subject to option decay or theta, not the intrinsic value portion of the option. Okay, here's a little tricky one. So stock is trading right around 50. Okay, we're going to ignore the stock trading 100. Now stock's trading 50. And we decide to buy the April 50, March 50 calendar spread, meaning that we're going to buy the April 50 calls and we're going to sell the March 50 calls against it. Do you think theta helps or hurts this position? Well, once again, because we're going to buy the April, they're further dated, and sell the Marches against it, since the Aprils always have to trade for more than the Marches do. Okay, so we're going to be putting this position on for a net debit. And because we're putting on this position on a net debit, you might think that, okay, my theta is going to impact me because I'm paying for the position. That's going to impact me negatively. But actually, remember that theta is more pronounced for the near-term at-the-money contracts, not the farther dated contracts. So in this case, even though we paid, a debit to put on this position, okay, theta actually helps us, okay? Because you can kind of think of it like this. We put this position on, we put it on because we are near-term neutral and say farther term bullish, okay? Ideally, we would like the stock to sit around 50 or just below 50 come March, where these Marches expire worthless. And then in April, we would like, after March rolls off, we would like the stock to make a big move to the upside. Okay, so theta in this case, because we are short the near dated option, is actually our friend. Okay, we are long the further dated contract, short the near dated contract. Theta actually helps us. So another way to look at this is you're long the April, short the March. You're long the Aprils have more Vega, so we're long Vega, short gamma. Okay, so in other words, once again, because we're short gamma, we don't want that stock really to move much. We want it just to sit right around 50 or around 50, where these near dated are decaying at a greater rate than the Aprils. Okay, so now let's talk about the most important Greek. I find this is the most important Greek, is implied volatility. And this is actually, given the environment that we've experienced over the last couple days, this is really a big one. So what exactly is Vega? Well, Vega is your options sensitivity to changes in implied volatility. In other words, how much my options expected to change with each 1% point change in implied volatility. It's always expressed in a decimal form, represents a cash amount per option, all other pricing factors remaining constant. So calls and puts have positive Vega amounts. In other words, if implied volatility goes higher, which was what we've been witnessing, actually today it went lower, but on Friday and Monday, it went considerably higher, okay? If implied volatility goes lower, that's going to lower the value of our options by the amount of our Vega, okay? So once again, when people talk about implied volatility, all they're really referring to is the level of options prices. So as when the market rolls over and people get really nervous, people start bidding up option prices, okay? Implied volatility goes higher because people are reaching for puts, they're reaching for calls to play on the upside. The implied volatility, the expected move for those stocks is increasing, and that gets priced into the options, so the options implied volatility. Now, the thing about implied volatility, oftentimes it doesn't change in a simple 1 percentage point increment. Sometimes it changes in 1, 5, 10, 25, 50 percentage point increments. It can move in a big way. And I can tell you personally, when you're on the wrong side of a Vega move, if you're short a bunch of options and you're short Vega and volatility is expanding, that can be very, very painful. Okay. And I can just tell you that firsthand. We were witnessing the VIX, which is a measure of the implied volatility on the S&P 500 options. On Friday, the VIX closed at 2339. Well, Monday, it traded, or yesterday, it traded as high as 65 when we were rolling over. Okay, that's a huge move. Today it was down 29% because of the big rally. Okay, so implied volatility, if you're on the wrong side of a Vega move, that can be either, if you're on the right side, it can be really good. If you're on the wrong side, it can be very painful. So there's two types of volatility. There is historical or delivered vol and implied volatility. So when we talk about historical volatility, what we're looking at is how volatile a stock has been over a given period of time. Okay, so it's a backward-looking metric. So here we're looking at historical volatility. We're just measuring how volatile that stock has been over a given period of time. Now, implied volatility, only options have implied volatility. Implied volatility is measuring how volatile that stock is anticipated to be between now and its expiration, and it's doing so through the price of the options. Okay, so when we put in all the components into a pricing model, the stock price, the strike price, time expiration, implied volatility, interest rates, dividends, okay, that model is going to spit out an expected value. Okay, and as we move the implied volatility around, okay, if we raise the implied volatility, if I have an implied volatility dial and I raise it up, well, that's naturally going to increase the price of those options. And if I dial down the implied volatility, that's naturally going to decrease the price of those options. Okay, so once again, option prices are impacted by the laws of supply and demand. So anytime there's greater demand than supply for options, in other words, more buyers than sellers, we're naturally going to see higher prices, which equates to higher implied volatility. Likewise, if we have more sellers than buyers in the options market, well, naturally, implied volatility would move lower, okay, because more sellers than buyers would naturally result in lower prices. So when you pull up your favorite stock on your screen and you see all these options prices and they're moving around and you see bids and offers and you see prices changing and you ask yourself, well, who's making all these prices? Well, the prices that you see at any given time, those are not random, okay? It's the consensus or the crowdsourced pricing of those options at any given point in time. So anybody who's trading those options, could be you as an individual investor, it could be me like I used to be a market maker, it could be hedge funds, pension funds, banks. Anybody who's interacting and buying and selling options is having effect on the prices of those options. And as they're having an impact on the price of those options, they're having an impact on the implied volatility for those options. So a change in a stock's historical volatility may or may not affect an option's price. However, all other pricing factors remaining constant, if implied volatility increases, both call and put prices will naturally increase. And as implied volatility decreases, both call and put prices will naturally decrease. This is through a concept known as put-call parity. So keep in mind that options that share the same strike in the same month have a direct relationship to one another. Now, I'm not going to get into put-call parity, but just know that they have this direct relationship. So calls and puts that share the same strike in the same month, if the implied volatility goes up, it's going to affect the prices of those options equally, okay? And likewise, if the implied volatility goes down for those options, it's going to affect both the call and the put prices equally. Okay, so let's look at an example. So here we have a stock trading right around 100, 13 days to go to expiration, and let's just say they're due to report earnings in a week. And we see that the implied volatility is 50%. So we're bullish on this stock, and we want to play for a move to the upside. So we look at the out of the money 105 call. It's trading for $1.85. And you can see the corresponding Greeks underneath this. We have the options delta, gamma, Theta, Vega, and Rho. So we're bullish on this stock, and we think it's going to make a big move to the upside. So we buy these calls for $1.85. Now let's fast forward a week. So a week goes by, the earnings comes out, they're good. Stock rallies 5%, goes from 100 to 105. But look at the value of the option. Now that option is worth $1.20. And you ask yourself, well, God, the stock made a $5 move to the upside. Why is my option worth 65 cents less than what I paid for it? Okay. Well, there's a couple things going on here. One, time to expiration. When you bought these options, they had 13 days to go to expiration. A week later, now they only have 6. So you've had theta negatively impacting your options position. You can see the theta increasing between the option being 13 days out and now it's 6 days out. Okay, your theta is increasing, so you've got that working against you. But look at the implied volatility. It's down 40%. It went from 50 down to 30. Okay, so even with a $5 increase in the share price, these calls lost value due to time decay and a decreasing implied volatility. So in this case, even though the stock made a 5% move, it wasn't enough to counter the effects of implied volatility or time decay. Now, had the stock gone from 100 to 110, now this would be a different story, because at 110, this $105 call would be in the money by $5. It would have $5 of intrinsic value. And with a week to go, maybe it's got 25 cents of time premium. So now we'd be sitting on a winner. But we needed a bigger move than 5%, probably a 7.5% move or more to make money on this option. Okay, so this is where it's really important when you're evaluating the options that you're buying or selling. That's how you evaluate whether the options are cheap or expensive, is through analyzing the implied volatility of that option. All right, so now let's do one more knowledge check. So we have a stock with the 100 strike call. Do you think the Vega is greater on an option? We're going to be looking at the 100 strike call for the 5-day expiration, the 30-day, and the 90-day. Which call do you think has a greater amount of Vega? Well, Vega is always going to be more concentrated in the farther term at the money contracts. And that's because they're comprised of more time premium. Okay, so as implied volatility goes up or down, it's going to affect those more Vega heavy options, the further dated options. So in this case, the 90-day options certainly have more Vega than the 30-day or the 5-day options. The 5 and 30-day options do have Vega, but not as much as the 90-day options. If we were looking at the leaps that expire in a year from now, they would have even more Vega than these 90-day options. So the options that are farther term at the money options have the most amount of Vega. Okay, an investor puts on a covered call strategy. Once again, we buy 100 shares of stock. We sell either an at the money or out of the money call against it for income. Do you think do we have a long or short Vega position? And will an increase in Vega help or hurt this position? What do you think? Well, if we are long stock and short an out of the money call, okay, because we are short the contract, we're naturally going to have a short Vega position. So if implied volatility goes up, that's actually going to make the price of that option a little higher, and we would be sitting on an unrealized loss should we cover the position. So we are going to be short a little Vega, and a rise in implied volatility actually hurts the position. A decrease in implied volatility would actually help our position. A rise in implied volatility would hurt the position. Okay, if a stock drops 15%, and God, we saw a lot of these yesterday, as a result of, say, unexpected company news, what do you think? Do you think long or short Vega positions are likely to be positively impacted? Well, remember that Vega is your option sensitivity to changes in implied volatility. So if we own options, okay, we benefit from rising implied volatility, and we are negatively impacted by a decrease in implied volatility. So if all of a sudden stock drops 15% unexpectedly, we would pretty much assume that implied volatility, it's going to catch the market off guard. The implied volatility for those options would naturally increase. So in this case, positive Vega positions or long Vega positions would be the better position to have. In other words, we want to be long options where we're long gamma, long Vega. A rise in implied volatility helps us. A big movement in the underlying helps us as well. Okay, so now let's look at the last first order Greek, rho. Now, rho is probably the least impactful out of all the Greeks, okay? This is your option sensitivity to changes in interest rates. So how much your options expected to change with each 1 percentage point change in the risk-free interest rate, always expressed in a decimal form, represents a cash amount per option, all other pricing factors remaining constant. So, you know, I always consider this kind of the least significant of all the pricing factors, okay? It's a component of the cost to carry. And, you know, honestly, I have no control over interest rates, okay? If I could tell you where interest rates were going to be in the future, I'd be giving this webinar from my yacht in the Mediterranean, but I don't know where interest rates are going. All I can do is look at a yield curve and get a feel for where money is being priced by looking at a yield curve, okay? But I have really no control over it. So when I was trading and I have my net position, I'd have a gamma position, a theta position, a Vega position, a delta position, and a rho position. You know, I have really no control over my rho. I'm either long or short rho, and interest rates, you know, depending on what they do, are going to impact me one way or the other. Another thing to keep in mind is how often do you see interest rates change by 1 percentage point changes, okay? Typically, the Fed either increases or decreases by quarter points, eighth points, you know, in some rare instances, half a point. But, you know, very rarely do you see interest rates rise or fall by a full percentage point change. Now, how does interest rates affect our calls and puts? Well, calls have positive rho and puts have negative rho. Okay, and rho is always going to be the largest for the in-the-money calls and puts, and that's because the in-the-money calls and puts have the most amount of premium. They're the premium-heavy options. Okay, so as you move away from as you move away from the in-the-money contracts, okay, your rho actually decreases, so it's more impacted on the in-the-money contracts. Okay, so one way to think about rho is it's kind of like when you think about rho, it has to do with the time value of money. Okay, so a couple years back, interest rates were practically zero. Okay, well today, you know, you can put your money into a money market fund and earn roughly about 5%. Okay, so as rates increase, that's naturally going to increase call values and it's going to decrease put values based on the time value of money. So one way I like to think about this is, let's just say you have $100 and you put it into a money market earning 5%. Well, a year from now, your $100 is going to be worth theoretically about 105. Okay, the future value of your $100 is worth 105 at 5%. Well, stock prices also have a higher future value as interest rates go up. Okay, so as interest rates go up, the value, this is why it impacts the value of calls to the upside. Calls increase and puts naturally decrease as rates increase. And as rates decrease, as rates go lower, that's naturally going to have a decreasing effect on call values and an increasing effect on put values. Okay, and once again, rho is always going to be more significant for the longer dated in the money options because they are the more premium heavy options. Okay, so further term options like say leaps are going to have a lot more rho than say, you know, options that expire in a week. Okay, short term impacts, shorter dated options have rho has a very nominal effect on the value of those contracts, but it has more of a pronounced effect on the longer dated in the money contracts. Okay, that is the end of the presentation. I know that was a lot. For more information regarding this topic or any others, you can reach out to us. Here is our information. And once again, our website, optionseducation.org, where you can see our full online course curriculum and our free educational resources. If you ever have questions, you can shoot us an email at options@theocc.com, Monday through Friday from 8 a.m. to 4 p.m. Central Standard Time. And you can always check out our YouTube channel as well as our Twitter handle as well. So with that, I'm going to bring back Natalie. And I mean, I know we're at the hour, but I'm certainly happy to answer some questions if there are some out there. So.
Great. Thank you so much, Ken. I'm going to ask you to leave your screen up just for a moment so everyone
Sure
can
thing.
write down all these really helpful sites because, as you pointed out at the beginning, the OIC is just an amazing wealth of knowledge. And as we mentioned, it's all free. So we encourage everyone to go check it out. As Ken mentioned, everyone, we are pretty much at our time. However, if anyone has any last minute questions, type them in the chat box or Q&A box. If you think of something later tonight, tomorrow morning, you can send your questions over to us at info@tradeagt or directly to the OIC. Reach out to them, use these links, and get your questions answered. We did, Ken, get a few questions come in during your presentation just asking, okay, this is a lot of great information. Is there going to be a recording? And the answer is yes to everyone who asked. We are recording this and we will send you the link to that replay tomorrow. That's also going to come from info@tradeagt as well. So with that, we are right up at our time here. And I know everyone's got schedules to lead, including Ken as well. So Ken, thank you as always for taking the time to put together such a detailed and really helpful presentation. It's always really great having you on, and we always get a lot of great feedback when you present, so we do appreciate it. Definitely want to have you back again soon, and thank you to everyone who joined us live. You took time out of your own busy schedules and hopefully really increased your options trading knowledge, particularly about the Greeks today. Thank you again, everyone, and we'll see you at the next free trading webinar. Until then, good trading.
Thanks, everyone.